In today's lecture, we will be looking at 7 relevant topics to REITs. We'll be looking at the concept of REITs, we'll be looking at the different types of REITs, the different stages of REIT maturity, the REIT market in terms of its size and performance, the rules governing the establishment and the distribution of REIT income, how to measure REIT income, and how to value REITs. Now, let's begin. To give us an idea about the concept of REITs and a summary of how it works, I have inserted a short video which can provide some guidance. I hope you will take your time and have a look at that video. Because of this, I would skip this video and move on to today's lecture. Now, what is the concept of a REIT? I will show you how a REIT looks like and how it works using a diagram. But before I do that, let's take note of the rationale for the development of the REIT investment vehicle. First, investing in real estate has long been a well-known method of wealth creation. Favored by many and with a myriad of options to choose from, individuals are spoiled for choice when it comes to their investment options. However, traditional real estate investment modules present immense barriers to entry. Apart from the onerous burden created in terms of regulatory procedures, the financial aspects attached to them make investing nearly unfeasible for most potential investors. For example, if you wish to own property in a foreign country, in addition to the significant capital required for the purchase of the asset, you will typically also be required to incorporate a local entity as an investing partner due to restrictions imposed on foreign investors in most jurisdictions. Apart from this, you also need to fulfill the statutory requirements, including but not limited to tax, accounting, and ongoing registration obligations, which have significant costs associated with them. In addition, there may be further restrictions on the type of property funds that an investor may invest in, thus limiting choice and access to capital. Foreign direct investment also has vulnerabilities attached to it in terms of the ever-changing micro and macroeconomic conditions in each country. To mitigate this risk and overcome investing challenges, the market offers real estate investment trust as an alternative investment vehicle to many investors. REITs were therefore first created in the US in 1960 to allow smaller investors to participate in property markets and invest in institutional quality real estate. Now, what is a REIT? A REIT is a trust, a corporation, or an association that owns or finances income producing real estate and can be publicly listed or privately owned. A REIT enables small investors to invest in the shares of a trust, thus making them shareholders or part owners. A REIT invests in the capital raised to real estate of all kinds, i.e. residential, commercial, industrial, hospitality, recreational, etc. They often buy and hold real estate assets in a portfolio for its returns in the form of rental income and interest payments on loans over time. The rental income and interest are then distributed to the REIT shareholders in the form of dividends. Now, this is a basic concept of a REIT. I have attached a video to a lecture delivered by the CEO of a REIT somewhere in Singapore, which you can have a look at for further details. Now, are there any types of REITs available? I would like to tell you about 3 different types of REITs available. We have what we call mortgage REITs and what we call equity REITs, and the last category being hybrid REITs. A mortgage REIT provides loans to residential and commercial real estate borrowers or invest in property that are backed by mortgage-backed securities. Equity REITs, on the other hand, buy and own real estate directly. They may be focused on a particular property sector, i.e. office, retail, hotel, and multifamily real estate. They may also focus on specific regions of the world. So for example, you may have a REIT that is focused on Africa, a REIT that is focused on Europe, and a REIT that is focused on, say, the US market. Within these regions, you may have a focus on sub-markets. So for example, in Africa, a REIT may focus on some specific countries. Like for example, a REIT may focus on Ghana. The hybrid REIT category is just a combination of both equity and mortgage REITs. This category of REITs comprise a relatively small proportion of the overall REIT market, and so I wouldn't spend more time looking at this type of REIT. Now, what are the stages of REIT maturity? According to a report by Ernst & Young, REITs go through 4 different stages, being the nascent stage, the emerging stage, the established stage, and the mature stage. REITs jurisdiction maturity assessment is an attempt to group REIT markets around their evolution and identify themes that are common to them. Australia and the UK are urging closer to being considered mature markets, but the principal area of debate is between the emerging and the established categories. Belgium was moved to the established group, having been classified as emerging the previous year, while Finland and South Africa are on the verge of elevation. Finland has had REIT legislation for 8 years and scores well on many metrics, but remains constrained by a lack of active REITs. South Africa, on the other hand, is a relatively young regime, although the biggest REIT market in Africa, but maturing fast and now has 23 active REITs as well as a number of secondary listings from overseas REITs. South Africa also rates well on important metrics like capital market maturity, corporate governance, and real estate transparency. Elsewhere, jurisdictions like Ireland, Spain, Mexico, will likely be considered established in the near future. The size of the global REIT market continues to grow since the release of the Ernst & Young report in 2017. Market capitalization of REIT regimes around the globe rose by approximately 4% to 1.7 trillion US dollars from the first half of 2016 to the first half of 2017 on a US dollar basis. But virtually all of these expansion is attributable to the approximately 58 billion US dollar of equity capital raised by the industry during that period. With 4% growth during the period, the US REIT market continues to dwarf all global markets and is roughly twice the size of all other markets combined. In local currency terms, Spain, Singapore, and Hong Kong have led the way with the most significant growth through 2017 to date. These are a list of countries and the stage of development of their REIT markets. Take a look at them and look at the commonalities between them. Is there a difference between a REIT and a property company? Very often, many people think that REITs are the same as property companies. Today, I would like to inform you, I would like to notify you that a REIT is not the same as a property company. And so let's look at the differences between a REIT and a property company. A property company may also be called a propco or a REOC. Now, a REIT is different from a property company in two main ways. That is, in terms of its tax treatment and its regulation. A REIT is often called a tax-neutral or transparent investment vehicle, unlike a property company. REITs generally do not pay taxes at the company level, provided that they conform to a number of restrictions which typically include the following. 1. That they discharge a majority of taxable income as dividend. 2. That they limit their leverage. And 3. That they limit income generated from real estate development, which in our previous lecture we learned was a type of real estate investment strategy. Now, a property company is, however, a taxable